Yeah, my name is Angelo Mfilinge. I would like to talk about the Tele Financial Accounting Program. Tele Financial Accounting Program, it is a financial account. It's just a software that can help business controllers, financial managers, businessmen, and directors to control well and supervise their companies or enterprises. Under Tele Financial Accounting Program, we have various modules. The first module is accounting basics. The second is Tele fundamentals. The third is accounting masters. The fourth is uh, accounting Tele. The fifth, inventory Tele. The sixth, advanced accounting in Tele. The other one is the advanced inventory in Tele. The other one is job costing. The other one is point of sale. The other one is value added tax, or we call it as a VAT. The other one is tax collected at the source. The other one is central sales tax. The other one is budget and scenarios. And also we have multi-currencies. Also, we have inventory or stock valuation in Tele. Mostly, and these are mainly the topics or modules that you can start in Tele Financial Accounting Program. To start with the first module, accounting basics. First of all, we start to define what is accounting. Accounting is the process or systematic way of recording business transactions. That is accounting. And when we say account, means the record of business transaction. Account is just a record of business transaction. After that, we can see the types of accounts. We have three types of accounts. The first is personal account. The second is real account. Personal account is the account related to person or a firm. The real account is the account which is related to possession or property. For example, furniture. This is a real account. And the nominal account, this is the account that is related to profit and gains, and also losses and expenses. This is what is known as a nominal account. Now, golden rules in accounts. Golden rules in accounts, this affects both the giver and the receiver, or losses, expenses, and gains of profit, and also the what comes in and what goes out. It depends on the type of the account. Under personal account, the golden rule in accounts, that is personal rule, personal accounts, personal account rule states that you debit the giver, you credit you debit the receiver, you credit the giver. It means when you received something, you give something in return. In a real account, uh, you debit what comes in and you credit what goes out. As I have said that the real account is the account of the possession or property. So when you receive something, you received something, you are debited, but when you give something, you are credited. Now, under the golden rule, we have real account rule, which states that debit what comes in and credit what goes out. Under nominal account, we have nominal account rule, which states that debit all losses, expenses, or debit all losses and expenses, and credit the gains and profit, and also revenue. That is the that is the nominal account rule. The other part we can see double entry. Double entry system is the system of recording transaction in two accounts, in which one account is debited and the other one is credited. That is double entry system. It's the system of recording a business transaction into two accounts, in which one account is debited and the other one is credited. That is the double entry system. For example, if we say purchased goods, purchased goods on cash, we have two accounts: we have purchases account and the cash account, whereby the purchases account is debited because goods are being received, and cash account is credited because cash is being removed, is being given out on return of the goods received or purchased. That's the double entry system. Now let us see a few basic terms in accounts. We have a transaction. Transaction is any business activity that may involve as exchange of goods between two parties. That is transaction. So transaction refers to money or money is worth as the exchange of goods between two parties. Example, we have purchases, we have sales, etc., etc. That is transaction. Then we have asset. Asset is any economic resource that is owned by business. It's known as asset. It can be current asset. It can be fixed asset. Fixed asset is any asset that is not transferred. For example, plant and machinery. We have buildings. We have land. That's fixed asset. Now we have current asset. Current asset is the asset that can be transferred. For example, we have cash. Another, we have the characteristics of asset. One of the features of asset is that asset can be converted into monetary value, must be converted into monetary value. That is the main characteristics. The second one is it must be owned by the business. The other term is liabilities. Liabilities refers to any obligations that are on the use of asset. Obligations on the use of asset. That is liabilities. Any obligations on the use of asset is known as liabilities. It can be short-term liabilities or long-term liabilities. Short-term liabilities, for example, have creditors. And long-term liabilities, for example, loan. These are liabilities. Another thing is capital. Capital refers to any holdings or interest by the company. If the amount that is invested in the company or in the business is known as capital. It can be owned as equity or borrowed for investment. Another thing is what is known as a creditor. Creditor is a person who is payable, whose money is payable, is a person whose money is payable for goods purchased. Credit. And debtor is a person from whom money is payable. Debtor is a person from whom money is payable for goods for goods purchased on credit, but creditor is a person to whom money is payable for goods sold on credit. That is the difference between creditor and debtor. These are credit-based transactions, are known as creditor and debtor. Again, we have another which is known as we have seen a creditor, we have seen assets. Yeah. Then we have seen assets, we have seen creditor, and the liabilities. And also we have the so-called balance sheet. Balance sheet is just a summary statement which can state the position of the business, stating the liabilities and assets. It relates liabilities and assets. That is, uh, if the assets exceed the liabilities, then it is capital. It means the business is sound. You will not borrow uh, uh, an amount as a liability, as a capital, if the liabilities is less than the asset is less than liabilities. That's why you can derive the equation, asset equation, which says that asset is equal to liabilities plus capital. Thank you very much.